Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So if you've watched pretty much any of my videos ever, you will know that I'm a big time Warren Buffett fanboy, and he's had a huge influence on how I approach investing today and how I will continue to approach investing out into the future. And although Buffett has many timeless lessons on investing, one of the ones that's really stuck with me, particularly over the last couple of years, that has frankly changed how I approach investing quite a lot, is this idea of having a punch card with 20 holes in it. And every time that you make an investment in a new business, you have to punch out one of the holes in that punch card, and those 20 punches are all that you get in your life. So once you've made your 20 investments, you're pretty much done. And those are all the decisions that you're able to make in your investing life. So it forces you to think really, really deeply before you invest in any given company. And it's been very influential on how I approach investing in the stock market. So I want to talk through that today, how I've applied it to my own investing, where it's helped me a lot and where it's potentially hindered, and kind of some of the downsides as well. So I do hope you enjoy that. Before we get into that, we do have a sponsor for today's video, and today's sponsor is Hatch. Now, Hatch have been my broker of choice for well over 18 months at this point in terms of me buying shares in US companies from here in New Zealand. Now, I initially switched across to Hatch basically because of fees. I was paying $90 a trade with one of the big banks. I can now do that exact same trade in Hatch for $3. So massive money saver in terms of fees. They also have far more attractive foreign exchange in my experience than I, again, had with some of the big banks. And I should also say that if you're watching this video on the day it gets released, they actually have a foreign exchange sort of deal going for Black Friday at the moment. So if you're interested in saving some money on foreign exchange with putting New Zealand dollars into US dollars, I'll put the details up on the screen here, so certainly check that one out. If you're interested in getting started with Hatch, you will need to go to the link hatch.as/investingwithtom. If you go to that link, sign up and create a new Hatch account and deposit 100 New Zealand dollars into that account, you'll get basically a free $20 top up. So you'll get a little bit more cash from Hatch deposited into your account, and you get started investing with a little bit more money. So, Warren Buffett's punch card analogy. Like I said, this is basically the idea of you having a limited number of financial decisions that you can make in your life. And basically, the smaller the number of financial decisions you have available to make in terms of making your investments, the harder you are going to think about each and every one. Now, with the stock market, I think there is a significant temptation to sort of dabble in investing, to have small positions in a whole bunch of different companies, or maybe to get started investing and only put small amounts of money to work and just kind of dip your toe in the water and that sort of stuff. You know, you can buy into a stock and see it move up or down sort of 1% in a day, and you know, it feels real good and all that sort of stuff. But in order to make actually a significant difference in your financial life, I think it's important to take these investment decisions very seriously. And when you do put money to work, have a high level of conviction and be very comfortable in putting some of that hard-earned money to work. So this punch card analogy has been super powerful for me in order to do that. And I've basically taken on the philosophy now that each year that I am looking for places to put money to work, I'm really happy if I can find 1 to 2 investments in a year, and that's it. And that achieves a few things. It means that I can say no very easily to a lot of stuff. If I see a stock pop up in a 13F that a famous investor is invested in that I like, but I don't necessarily understand it, maybe something like a Micron Technology from Monas Probri, it's really easy for me to say no to that. It means that I don't have to swing at everything as an investor. If I can buy into 1 to 2 new companies each year, and I do that over a 10, 20, 30, 40 year period, over time I think you develop a very high quality basket of businesses and investments, and you probably come out the other side with a pretty good track record. So that's kind of the way I think about it. It takes a lot of the pressure off finding investments. If I take 2020 for example, I've bought into 2 stocks all year. You know, I'm someone that sort of lives and breathes investing and makes 2 to 3 videos a week on the topic, and here I am, you know, only buying into like 2 new companies all year. I was close to buying a third, but I didn't quite get there on that one. I've added plenty to the watch list. I've probably added 5 or 6 companies, maybe even slightly more to the watch list, and I have sort of purchase prices that I'm comfortable to buy into each of those businesses. So I'm certainly not being, you know, lazy and not researching into new companies or anything like that, but it just takes a lot of the pressure off, and it allows me to be very disciplined on price, paying an appropriate price, and making sure I lock in a margin of safety with all of the stocks that I might be looking at. Now, one of the other advantages of taking on a philosophy like this is that it's very easy to avoid really dumb errors. Warren Buffett describes the story of, if he went to some sort of cocktail party and some guy who knows nothing about investing really, but, had invested in some speculative company and had made a whole bunch of money on some business that you didn't even understand, and you get stock tips from this person. It's very, very easy to dabble in those sorts of things for particularly a beginner type investor. But if you're someone who has taken this philosophy on board of only having a limited number of investments in your entire life, it's very, very likely that you're going to be able to say no to that quickly and be able to get those kind of dumb potential errors out of the way. And the other advantage that we have as smaller investors, if you put it in sort of a baseball context like Buffett often likes to do, is we have no called strikes. We can watch pitch after pitch go by, in this case company after company go by. We can continue to discard it and say no and say no and say no until something comes perfectly in our sweet spot that we understand and that is available at an attractive price. And those are the pitches that we swing at. If we don't get any of them all year, that's completely fine. If we get 5 or 10 of them in a year because we've gone through some sort of financial crisis and there's all of these businesses suddenly available to us, that's fantastic as well. And that's kind of just the way that it will sort of average out over a long period of time. We don't have, for the most part, unless you're a professional investor, we don't have typically other investors in our ear saying, do something with my money. We're managing our own money for the most part. We're small investors and we can be nimble, we can be patient, and we're not going to have a whole bunch of pressure to actually just dive in and do something and get pushed into stocks that are going up 5 or 10x. And again, have people in our ear, telling us to invest in these businesses and so on. So it's a really useful tool, and it's one that's had a massive influence on my investing, particularly in the last couple of years. Now, every investment strategy has both positives and negatives, and arguably one of the easiest negatives to argue against this strategy for is that you're going to miss out on a whole bunch of big winners. You're going to say no to the next Amazon, you're going to say no to the next Apple, you're going to say no to the next Microsoft, and that is completely true. We're going to miss a lot of stuff, and that's fine. I think you have to be willing to accept that as an individual investor that focuses on high quality businesses, buying them with a margin of safety and all that sort of stuff. Because here's the thing, if we buy into say 20 companies, maybe even 30 companies in our entire lives, we don't actually have to be right on all that many. If you can put say $10,000 a year to work and you can buy 20 or 30 companies over your lifetime, and on average they do say a market rate of return or maybe even slightly below a market rate of return, maybe they do 6 or 8% a year, that's probably still going to turn into a reasonable amount of money. But if you have baked into that 20 or 30 5 investments that you were really confident on and worked out absolutely spectacularly, which that should be a possibility for every investment that you put into your portfolio ideally, but still tied in with a margin of safety and downside protection. If you have 5 or 6 of those work out and they do 30% a year over that time, you're going to get very, very rich. And it's not going to matter that you missed Amazon or you missed Microsoft, because you're going to have 5 companies that, have potentially turned your $10,000 investment, 20 years ago into hundreds of thousands, if not millions of dollars if you've made, really, really high quality investments in those stocks. So I think you have to be willing to ignore a lot of opportunities if you can't quite get there on them, if you can't get the high level of conviction and understand them really, really well, and being willing to accept that you're going to miss some stuff, but as long as you pick, a good group of investments over a long period of time, you'll still do very well. If you can get that mindset into your head, I think that's going to be very helpful. So that's all from me for this one. A pretty quick video today, but it's certainly one of my favorite Buffett lessons and one of the ones that I've certainly taken on board pretty aggressively in the last couple of years, and it's been super useful for me. So I do hope you learned a lot from that video. If you did, please hit like and hit subscribe. If you're interested in the Hatch offer, again, the link will be up on the screen here and it will be down in the description below. So go get your free $20 and your foreign exchange discounts and all that sort of stuff if you're interested. And I'm going to leave you with a Buffett clip after this sort of outro as well, where he sort of talks about this punch card analogy. So sit back, relax, and enjoy that part of the video as well, and then I will see you in the next one. Cheers.
Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really gotta grab them when they come, because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it, and every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company, you didn't even understand what they did or couldn't pronounce the name, but they'd made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. You know, it's easier now than ever because you can do it online. You know, just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life. You would think a long time before every investment decision, and you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to. Yep.